Hi everyone, and welcome to Financial Basics, where we make money grow with you. Today I want to be talking about the topic of financial advisors and try to answer the question, is it actually worth it? So I want to just start with sort of a disclaimer. Financial advisors do not and cannot take away responsibility of managing your finances or understanding what's going on with your finances just because you've handed it off and delegated it to somebody else. You need to know what you are invested in, and you need to know what fees are being charged. I've spoken to so many people where if I ask them, what are you doing with your retirement funds? They'll tell you it's invested in Vanguard. And then you ask them, okay, Vanguard is the holding company. It's the company that is looking after your money. What are you actually investing in? What are they actually putting your money into? And they'll say they have no idea. And they don't know if it's bonds, if it's mortgages, if it's a high yield investment account or high yield savings account. And if it's investments, like if it's like shares or equities, then they don't know what those equities are. So understanding these things, even if you've delegated to a financial advisor, is really, really, really important. And the reason for that is because you cannot, under any circumstances, it is really difficult to go back to somebody 30 years later, potentially after they've already died, and say, well, actually, I don't have enough money to live, or I don't have enough money in my retirement. Or, you know, your financial advisor, you find out 3 years later, your financial advisor has put you in really expensive, actively managed funds where he's earning a really high commission and you're getting, relatively speaking, screwed. There's not much you can do about it. That ship has already sailed. You did not take responsibility for your investments. You did not decide what you're going to do. You weren't actively involved. And you just try to delegate all of these responsibilities to somebody else. That's a really bad idea to start with. And then I just want to talk about the overarching thing that I see with financial advisors in the market, is that they spend a lot of time promising you higher returns than what you'll get. And Warren Buffett even made a bet for $1 million that there would be nobody out there that would take on his bet and beat just the S&P 500. Charlie Munger even said, if all you ever did was buy high quality stocks on the 200-week moving average, you would beat the S&P 500 by a large margin over time. And I think he's almost making a joke with this statement, because high quality stocks is the key word there, and determining what a high quality stock is really difficult. It's borderline impossible. And the reason for that is because there's an enormous amount of due diligence that goes on in determining whether a stock is a good purchase or is selling at the right price. And it automatically implies that there's some unknown secret knowledge that your due diligence is going to reveal that the general market doesn't know about or isn't aware of. Or they're choosing to ignore it, who knows. And I just want to make a reference here to what I call the magician's tricks, right? Too good to be true. And there are companies out there that spend a lot of time trying to market themselves, trying to advertise themselves, trying to paint a better picture than what is really going on. And the vast majority of the time, these guys aren't actually targeting you as an individual investor. They're targeting the organizations that manage your funds, or private equity, or large amounts of capital that are being allocated and assigned at the moment because they think it's a good investment, and in actual fact it might be misrepresenting. So they're trying to trick you. So there's people in the market that are absolutely trying to trick people. And they can fool you, and they can also fool large investment firms. And they can do this through a whole bunch of means, everything from asset stripping to, hiding the financials, misrepresenting the financials, not revealing exactly what's going on in terms of intellectual property. Even forged documents is a regular thing. And I've got a map there of China at night. There was a paper that was put out. It was one of the more interesting examples that they talk about, is trying to estimate the real GDP growth that China has occurred over the last sort of 20 years or whatever the case may be. I can link that article in the description, that paper in the description. But fundamentally, the gist of the paper is, should you trust the GDP figures that are coming out, GDP growth figures that are coming out of places like China, where there's a dictator, relatively speaking, in charge, and there's a lot of opportunity to manipulate that data. Same with Russia today with Putin. He's very much solo in power, in charge at the moment, and he can push to have the numbers manipulated or align those numbers with what he believes should be put out. The China example is using other data, so using satellite imagery of lights from China. Can you determine what a more realistic GDP growth rate is, and then compare those two values to see if they're telling the truth or they're trying to misrepresent what's actually going on. And what I want to emphasize here is a financial advisor doesn't actually need to beat the market. There's a lot of focus on that, and a lot of people are really interested in, can my financial advisor beat the market? Can they get extraordinary returns relative to the market? And I think that's not the right question to ask when you're speaking or engaging with a financial advisor. The real question, at least from my perspective, is, can they get you the maximum amount possible based on your specific criteria? So that's a different type of question. It's, what is your risk profile? What if you don't want to invest in companies that you consider ethically bad or morally bad? So you might not want to invest in companies that create missiles. And if that's the case, then the stock standard S&P 500 might not be the best thing for you. And then it's tailoring and building a solution that works for you, that still maximizes your return if you're compromising on some of these things. And then there's other goals like protection of assets, risk management. What stage are you in your investment life right now, where potentially just going all in on the stock market isn't necessarily the best thing to do? And then also, even post-retirement, once you've already retired, what is your withdrawal strategy? How much do you actually have in the pot? What does that look like in terms of the different asset classes? And then what you should be drawing down, what's the sustainable drawdown rate? And are there other factors, like you might have health concerns, you might have a certain life expectancy that's a little bit less for whatever reason, and then can those things come into play, which might free up more money or reduce how much money you ultimately get if they think you're going to go longer, right, than the average life expectancy, or the average 30 years, whatever the case, if you're using the 4% rule. So all of these different goals sort of deviate from the ideal, from the maximum financial return that you can get. And most financial advisors do not beat the market. But the thing I want to emphasize here is they might beat you. So if you are not the best financial advisor for you, and what I mean by that is, you might make rash decisions. You might decide single stocks are a better option. There's a bunch of bad decisions that you could make as managing your own money, and a financial advisor wouldn't make those obvious mistakes, relatively speaking, where they could be making better decisions for you overall and not beat the market, but still beat you. So what do financial advisors actually do? And these are the good ones. A good financial advisor is going to look at investment management, where they're talking about creating investment strategies, monitoring the investments, assessing your goals and your risk profile, and then just deciding and making decisions based on that. They're talking about retirement planning, and they're discussing it with you in terms of what sort of retirement you can expect based on these behaviors, and potentially also looking at different scenarios, like what you could change today to improve your financial position later on, or if you think you might have too much money later on, could you reduce? There's also a huge element of tax planning, and that's now and in the future into retirement, where they're just looking at how to minimize and reduce your taxes. And then also estate planning is a huge part of it, where it's, if you die, how that money gets distributed. So how your funds get passed on to your children or whoever you choose as your heirs to the estate. A good financial advisor should have a couple of key qualities. They should have a fiduciary duty. So they should, by law, have your interest at heart. If they don't have that, then you shouldn't be working with them. The fees should be clear, easy to understand, and simple. So ideally, you're looking for things like flat fees, hourly rates, and if it's AUM, then at least they should be upfront about it, where if you're having a conversation, where even if you already have a financial advisor, if you call them up tomorrow and say, hey, how much have you charged me over the last year? What has your fees been for the last 12 months? They should immediately have that answer. And if they hesitate, or if they say, well, let's have a conversation or let's have a meeting, then in my opinion, that is a little bit of a red flag. They're dodging the question fundamentally, or they don't even know the answer. And either of those is quite a scary thing to think about. They should have some type of certification, whatever that is, depending on the country that you're in. And they should also have experience. They shouldn't be new at this. They should have several years of experience with this. And they can demonstrate that experience. And the other thing to note is just in terms of showing you in writing and through discussion what they have done over any period and why, even if it's just with your finances. So if they've been looking after your money for the last year, you should be able to ask them, what decisions did you make? What inputs did you use to decide on those decisions? And why? Why did you make the investments that you have made? And they should be talking about comprehensive financial planning, not just investments. So if a financial advisor is only talking to you about the investment side of things and not talking to you about tax efficiency or estate planning or budgeting and debt management or any of the insurance needs that you might have, that is all a red flag to me. They are not being a holistic financial advisor. And for me, that is a little bit of a red flag in the sense that you should probably steer clear of those types of people, because they're very much, at least from my perspective, a salesman dressed as a financial advisor. They're trying to sell you stuff rather than actually engage with you on your specific needs and requirements. They shouldn't have any like conflicting incentives where there's potential pressure to sell specific products or services or investments. And anybody that pushes specific mutual funds, specific insurance or annuities, you should be very wary of those people and, in my opinion, avoid them at all costs. A good advisor will also educate you on multiple options And they're going to have strong communication skills and a strong education where they can actually talk about these concepts, these ideas, these areas that you might have questions on, and just clarify those things without going into jargon, without confusing words. And the other thing to note is there's also going to be a level of consistency where they're going to regularly check in on you, at least annually, but ideally way more often than that. Especially if you're paying 1% AUM and you have a substantial amount in your portfolio in the hundreds of thousands or even millions, it is absolutely crucial that you are paying for a substantial amount of their time. And that brings value in and of itself through those conversations, keeping you in the loop on what's going on in your portfolio, in your investments, and across your financial needs. And that links back to the very first slide that I showed, talking about needing to know what's going on in your finances. They will also have a personalized approach. So any questions you have, what are you asking you, what your goals are, what your risk tolerance is, what your values are. If you don't want to invest in a missile company, then that's really important, and they need to find that out. They need to engage with you to figure these things out together. And they don't push a one size fits all strategy. So they're looking at giving you a personalized, custom solution for your specific needs based on the conversations that they've had. They'll also have some form of references where you can go back and sort of check to see what they've done with who. And my suggestion would be not only to verify their certifications, but also, if possible, speak to reviewers directly. If they point you to Facebook reviewers or reviews, you can track those people down, message those people, reach out to those people. If it's on LinkedIn, the same thing. You can actually go and have a conversation with some of the people that might have reviewed them, and they could even potentially put you in touch with people that have reviewed them and that they've done work for. Potential signs of a bad financial advisor: lack of transparency on fees or clear conflict of interest. Steer clear of that. Promises of market-beating returns. No one can guarantee this. Absolutely no one. No one can promise you anything with regards to the market and market-beating returns. If they are doing that, not only is it a sign of a really bad financial advisor, but you might actually be dealing with some type of scammer. If they're putting any pressure on you to act quickly or rush or invest in specific products, I would also steer clear of that. And I'm talking not just steer clear of that action, but actually potentially walking away from this advisor in totality. And again, I cannot emphasize this enough. If they're only talking to you about investments and not the whole financial planning, that's also a little bit of a red flag, at least for me personally. Common misconceptions: they always beat the market. Most do not. Almost all of them do not beat the market. In fact, this was the real point of the bet made by Warren Buffett. It wasn't that there aren't funds out there that'll beat the market. It's that it's really hard to pick those ones in advance. They're only for the wealthy. You have to have large amounts of money before you can even speak to somebody, a financial advisor. But some actually offer flat fees, really affordable flat fees, and you can start to engage with them, even to just find out a little bit about this, about the concepts, about getting yourself educated from somebody that you trust and recognize. I think that's highly valuable in terms of your own financial journey and your own financial investments. And that all advisors have your best interests in mind. That is absolutely a common misconception. And conflicts of interest can absolutely exist, and usually do in some way, shape or form. They're ultimately interested in their own well-being and well-doing, financial well-being. And that means that it's a lot of effort and energy to make sure that the goals that they have are aligned with your own goals. So do you need a financial advisor? So one of the biggest value adds that I see is just behavioral coaching. And what I mean by that is helping you stay invested and avoid panic selling. And the flip side of that as well is also just as relevant, helping you stay out of a potential investment if everybody is jumping in and you go, my FOMO, I have to just put something into this. So it's potentially steering you away from that, because that might be a hype investment, it might be some type of scam, it might be some type of fad where everything is just, it's going to the moon, as they say, in the crypto world, and then all of a sudden everything just crashes. And steering clear of those types of investments, having a guide there for you to keep you away from that kind of thing, can actually be really beneficial in the long run. It also just gives you a layer of trust and peace of mind, especially if you're nervous. If it's the first time you're trying to manage your finances and get everything going, having somebody there to sort of check your homework, relatively speaking, making sure that you're making good decisions, that is a fantastic use of a financial advisor. The other thing to note as well, if you've got to deal with inheritance, tax strategies, with retirement withdrawal planning, anything along those types of things, if you're a business owner or high net worth individual, or if you just don't have the confidence to manage your investments yourself, all of these things, great uses for a financial advisor. And again, the importance here is long-term, consistent investing versus just chasing the highest possible return. So how do you actually go about choosing a financial investor if you've decided that this is what you want? Here's 10 really straightforward steps. Define your needs, figure out if it's retirement planning, if it's looking at taxes, if it's in investment management, whatever it is, figure that out. Decide on the fee structure. Do you want a flat fee? Do you want an hourly rate? Do you want an AUM? And then once you've started to select your financial advisors, look at their credentials, verify their fiduciary status, then do a little bit of a short list and start figuring out, okay, who am I actually going to interview? Do not interview less than 3 advisors. Don't just go with the first one. If you go with the first one, you're probably going to end up with a bad advisor. So go with 3, figure out that vibe, figure out how you're interacting with them in a conversation. And then from there, try and understand their approach. How do they handle investments? How do they do comprehensive planning? How many check-ins do they do? What's their availability like if it's 12 o'clock at night or even during the day, but they're on holiday? How is that handled? If the market tanks at that particular moment and you go into an emotional crisis, right? So they're almost there to back you up and support you on those things. And then review in detail what the contracts are, what the fees are, in full. Just ensure that there's full transparency there before signing anything, and then trust your gut. If something just feels off, whether that's pressure with sales or vague answers, absolutely the best decision you can make here is to just walk away and find somebody else. If you decide it's not for you, you can obviously just do it yourself. You can use index funds, you can look at tax software that'll help you figure out how much tax you should be paying. There's financial planning tools for drawdown rates later on. The key here, again, self-discipline, long-term consistency, and you have to know going into this that you're not emotional, and you're not going to make rash decisions. If the market were to tank and drop by 50%, are you selling, or are you staying in that market? And it's really difficult to sort of check your emotions at the door and make rational decisions, even in a crisis, even in a panic. So there's mostly three types of cost structures. There's the AUM, assets under management, where they're going to charge you a percentage fee. There's hourly or flat fees, so it's the same way you would pay to go see a doctor or a lawyer, or even an accountant on occasion, where you're paying a once-off fee for that interaction, for that engagement, and then you disengage after that. And then there's commission-based models where they're potentially trying to sell you specific products, and I put them in the category of more salesmen than actual advisors, where there is almost going to be a conflict of interest. They're trying to sell you specific products based on the commission that they get from those products. So this channel loves to do the math, so let's do the math. And what I wanted to do is I wanted to show that the advantages of a financial advisor aren't necessarily visible, because they're hidden in the fact that you make fewer bad decisions. And I just want to give an example of one individual making a bad decision halfway through their investment life. So if they started investing when they were 18 years old and they kept going with $235 per month for the entire lifespan of the investment, but let's say halfway through, they're about 41 years old, they're somewhere there, the market tanks by 50% and they decide to sell their investments. So they sell after the market has already tanked. It drops 50%, they think it's going to keep going down, they decide, okay, I'm going to cut my losses and sell. And they only reinvest it when it comes back up. So they don't get that ride outwards again. If they were to do that at the age of 41, if they were investing from the age of 18, they would have 200,000 by the time they were 41. But that 200,000 would become 100,000, because that's what they would have left after that dip. And this is assuming 8.5% in the market annually. So now they only have 100,000, but this time they're 41 years old. So between 41 and 65, they've got another 23.5 years. That pot, with that one mistake, is now worth 880,000. It's not bad, but that one mistake has actually cost them a hell of a lot of money when you think about it in these terms. So again, 8.5% growth, really good. They've walked away with 880,000. Now let's look what happens if you had a financial advisor that prevented you from making this mistake. If you started from zero and you went for the full 47 years, no mistake halfway through, but they were charging you 0.5% in fees every year, so you get 8% growth instead of 8.5%, you would end with 1.3 million. So $445,000 more money, because you had a financial advisor preventing you from making that mistake. Now this person would only see the 0.5% cost. They wouldn't see that the financial advisor, back when they were 40, prevented them from making a mistake where they could have been 400,000 lower. And it's the exact same contribution over the exact same period. And we can go one step further from 8%, 0.5%, which is quite low for an actively managed financial advisor, giving you advice throughout your career. you could say, well, what if they charged 1%? So if they charged 1% for that full 47 years, your return would only be 7.5. Exact same contribution for your lifespan of your investment. You're ending on 1,127,000, so still 246,000 more than they would have if they had not had the advisor and just made that one mistake halfway through their working career. Final thoughts. Deciding on a financial advisor and whether you need one is a personal choice, and it often depends on your emotions. And as I demonstrated, oftentimes the benefits are unseen or hidden. You only see the associated cost. Choosing one can be complicated, but being methodical in your selection process can actually really help. And I think that also extends into the relationship even once you've selected one. So in 5 years' time, if you have a bad interaction, that could be a sign as well to change financial advisors. And if you see any red flags at all during the selection process or even post the selection process, it is absolutely worthwhile to disengage from that relationship, even if it's a hard conversation. So I've often seen people say, well, they're doing it, everything's already set up, and I don't want to have that really tough conversation where fundamentally you're firing somebody from looking after your money, but the consequences of that could actually be really bad for you in the long run. And as I mentioned right at the beginning, you have to take responsibility for your finances, because in 30 years time, when it really matters and you need that money, it might not be there for you. Next video in 2 weeks time, I'm going to actually do a video on tariffs and how that impacts your personal finances. If you enjoyed this content, please just give me a thumbs up, subscribe, or share it with anybody you thinks might benefit from it. If you have any questions or requests, please email me at financialbasicsabc@gmail.com. The other thing to note at the moment is I am actively looking for people that are very close to firing or have already fired, because I actually want to try interview them and ask them just questions on how they got there and their journey. See you next time. Thank you. Goodbye.